Welcome to the case study series in Business and Government Relations by Skilled MBA. Japan's central bank has been at the forefront of a unique monetary policy experiment, maintaining yield curve control to combat deflation. In 2024, this strategy faces a pivotal shift. The Bank of Japan's approach, designed to stabilize inflation and support economic growth, is now under scrutiny as it navigates the complexities of a changing global and domestic economic landscape. Japan's deflationary struggle involved persistent low inflation and stagnant consumer spending, leading to a deflationary spiral. Structural challenges such as sluggish growth and an aging population further limited economic potential. Additionally, the yen's significant weakening against major currencies presented both opportunities and challenges for the economy. The Bank of Japan implemented unconventional monetary tools. Negative interest rates charged banks on deposits, promoting lending but reducing profits. Yield curve control capped 10-year bond yields at 0%, keeping borrowing costs low. Quantitative easing involved large asset purchases, expanding the Bank of Japan's balance sheet to 135% of gross domestic product, injecting significant liquidity into the economy. Global monetary policies diverged significantly. The Federal Reserve aggressively raised rates to 5.25 to 5.50% by 2023 to combat inflation. Meanwhile, the European Central Bank ended negative rates with 8 consecutive hikes. In contrast, the Bank of Japan maintained an ultra-loose policy, widening interest rate differentials with other major economies. In March 2024, the Bank of Japan raised short-term interest rates to 0.1%, ending 8 years of negative rates. The yield curve control framework was abandoned, prompting immediate bond market reactions. This marked Japan's first rate hike since 2007, leading to market volatility. Inflation neared the 2% target, driven by significant wage increases and a weak yen causing import-driven inflation. These factors catalyzed policy changes, prompting the Bank of Japan to reconsider its monetary stance. The economic landscape in 2022 and 2023 set the stage for pivotal adjustments in 2024, influencing both domestic and international financial strategies. Governor Ueda's strategy involves a careful exit from extreme monetary easing, ensuring market stability and maintaining credibility. The focus is on preventing capital flight and bond market shocks through strategic communication. Balancing political pressures with economic needs is crucial to preserving institutional trust and achieving price stability in a complex environment. Japan faces critical strategic questions. Can it stabilize inflation without harming economic growth amid a fragile recovery? Rising interest rates pose a threat to public finances, with debt over 260% of gross domestic product. Additionally, Japan's policy shift impacts global financial stability during a period of widespread monetary tightening. The yield curve control (YCC) experiment was a radical monetary innovation by the Bank of Japan, targeting a 0% rate for 10-year government bonds with unlimited bond purchases. Despite market distortions, it kept borrowing costs low. However, the policy's unwinding presents significant economic challenges for Japan. The yen's depreciation by 33% against the dollar from 2021 to 2023 significantly strained Japan's economy. To stabilize the yen, Japan spent wide to $9.2 trillion on currency interventions. This depreciation led to a 56% rise in import prices, fueling consumer inflation and heightening cost pressures on Japanese households. The Bank of Japan's experience highlights critical lessons. Precise timing in policy normalization is crucial. Premature moves risk deflation, while delays can cause instability. The yield curve control demonstrated central banks' ability to manage borrowing costs, yet it brought unintended consequences. Effective communication, as shown by the Bank of Japan, is vital to prevent market panic during policy transitions. Japan's monetary policy influences global financial conditions significantly. Higher Japanese rates lead to capital repatriation, affecting global capital allocation. The policy shift reduces the appeal of yen carry trades, impacting international investments. Additionally, Japan's tightening contributes to rising global borrowing costs, while regional central banks must adapt to maintain economic stability. Japan's tighter monetary policy aims to control inflation, targeting a stable 2%. However, this may dampen economic activity as growth remains fragile. Rate hikes support the yen but challenge exporters, complicating currency valuation. Balancing transparency and flexibility is crucial for maintaining market confidence and ensuring investor trust in the Bank of Japan's policies. Japan faces critical questions. Will inflation sustainably exceed targets? Can wage growth outpace inflation? The pace of Bank of Japan's policy normalization and the strength of domestic consumption are pivotal. Avoiding recession amid tightening is crucial. These developments offer valuable insights for global central banks navigating similar challenges. For more information, visit our website at https://skilledmba.com or contact us directly at support@skilledmba.com. +91 875 53 0795. Thank you for learning with Skilled MBA. We value your commitment to understanding global economic trends and their impact on strategic policy and financial stability. Skilled MBA's case studies transform intricate economic strategies into actionable leadership insights. By analyzing real-world scenarios, we equip future financial leaders with the skills to navigate complex economic landscapes. Our resources are designed to foster strategic thinking and decision-making, essential for thriving in today's dynamic markets. For more information, visit our website at https://skilledmba.com or contact us directly at support@skilledmba.com, icon timed +91 875 53 0795. Thank you for exploring real-world financial policy insights with Skilled MBA. We're committed to helping you understand and apply strategic decision-making in dynamic economic environments.